Do you know how infinite banking works? This is part 3 of our series. My name is Carmen.
And I'm Darius.
For the best infinite banking and financial advice, subscribe to our YouTube channel and hit the notifications bell so that you're notified when we upload new videos.
So far, we've discussed how the banks work and how we can copy their same techniques and apply it to ourselves using infinite banking. Now let's discuss why in the world would I use my whole life insurance policy and not my savings account.
Now we are going to dive a little bit more in detail as far as the numbers so that you understand the fees that are associated with using whole life insurance policy versus your savings account. So this is where we want you to pay close attention to how the whole process works and how, although there may be fees involved, you still end up ahead financially. And at the same time, you are building wealth for your family, not only by the cash flow that you're producing through your own banking system, but through the death benefit that you can leave your family when you pass.
Now, this is the part where if you haven't already seen parts 1 and 2, here's a link right here just so you can go back and get an understanding of how we built up to this point.
And this is the part where we flip our screen around and go through the presentation so that you understand why in the world would we use a life insurance policy. All right, ladies and gentlemen, welcome to part 3 of how does infinite banking work. So we are going to get started with, again, just another recap to make sure that we are all tracking on the same page. If you watched part 1 and part 2, we talked about the traditional flow of money. So if we just review what that looks like, you first are paid by your employer. Then that money is deposited into your checkings account. And if you are a good steward of banking, you should be paying yourself first, meaning saving money, and then paying your bills next. Now, as we transition out of the traditional flow of money, we have something that looks like this, because now we are incorporating infinite banking, where our employer first is going to pay us. That money will then be deposited into our checkings account. And instead of taking our salary and putting it in a savings account, we are going to take that money that we were saving and put it inside a life insurance policy and then pay our bills. And in part 3, we want to talk about using your savings account versus using a life insurance policy, because this is typically the natural progression when people ask about life insurance. Because why would I put money in a life insurance policy in the first place if I can just use cash? And we want to address that here in part 3 just so that you see the differences, so you understand how to maximize your efforts so you can leverage your savings to make more money for you. And just to reiterate, if you are currently saving money, we just use the average interest rate in the United States right now for a savings account, and that's 0.09%, versus a life insurance policy is paying a guaranteed 4% interest rate. And one specific detail that we haven't reviewed just yet is that when you utilize any of the money from your life insurance policy, there is a fee that is associated with borrowing money from your life insurance policy. And that is a 5% simple interest fee. So you will earn 4%. However, the insurance company is going to charge you a 5% fee for using your money. On the surface, you may look at this and say, you know what, Carmen, I'm still in a better situation by keeping my money in a savings account because I don't have to worry about this fee that I would pay to the insurance company. Because if you just look at these two numbers, it looks like right now I'm at a negative advantage than a positive advantage. So I want to clarify a few points before we move forward. The insurance company is only going to charge you a 5% simple interest fee on the money that you have borrowed. And you still might be saying, Carmen, the insurance company is charging me more than what I'm earning, so this doesn't look like a good deal. Because why don't I just use the cash from my savings account and not have to worry about paying a fee to anyone?
Yes, like Carmen said, we are going to walk you through the scenarios of using your savings account versus using your whole life insurance policy to pay off this credit card debt. So let me set it up for you. You have $6,600 available in your savings account. The credit card, however, the balance in the credit card is $6,354. You're paying 19.24% interest every single month, and you're going to be paying this for the next 41 months. So regardless of what you are doing, no one wants to give away 19.24%. So what do? We withdraw the money from our savings account. We withdraw the $6,000 needed to pay off the credit card. What we're left with is $246 in our savings account. That's what's available in our savings account after the withdrawal, because we subtracted $6,354. Now the credit card is zeroed out. Now it's time for us to do something with the $212.65 that we were going to be paying for the next 41 months. We use our savings account to now pay ourselves back the money that we would have paid to someone else. In this case, the credit card company. So now $212.65 every single month is going to our savings account for the next 41 months. At the end of 41 months, we have accumulated $8,718.65. This is only from the credit card payments that we're making to our savings account. So if we subtract the amount that was owed to the credit card company, which we originally borrowed, which is $6,354, that's a difference of $2,364.65. So now this $2,364 is what would have went away from us, which we now have sitting inside of our savings account. Now remember, you were earning 0.09% interest as you were making those payments back to yourself. So after 41 months, you've accumulated an additional $14.50. So congratulations to you. When we add these numbers together, that's $8,733.15. But remember, when we started, we left some money inside of our savings account. We left $246 in our savings account. So taking this into consideration, inside of our savings account, we have $8,979.15. I am not talking about any of the money that you're currently saving. I'm only talking about this one transaction. I repeat, I am not talking about any of the money that you're saving, any of the money that you're paying yourself first with. I'm only talking about one transaction of paying off the credit card. Now let's take a look and see what this looks like when we take out all the pictures. If we just focus on the numbers, this column is the year, followed by the cash in the savings account that is available for withdrawal. We have the withdrawal that we take from the savings account, and then we have the credit card cost at 19.24%. Next, we have the amount of money that we're going to be paying ourselves for the next 41 months. And this is the amount of interest that we are going to pay, but since it's a savings account, we don't have to pay any interest because we are using cash. Instead, we're going to earn 0.09%. Now, because it's a savings account, in this last column is nothing we need to worry about because there is no death benefit. So starting year one, we withdraw the money from our savings account. $6,354 is withdrawn from our savings account, leaving us $246 available in our savings account. Our credit card is now zeroed out. We're now, for the next 12 months, paying ourselves $212.65. If we multiply this times 12 months, it's $2,551.80 that we pay to our savings account. And as we're doing this, the 0.09%, we earned $1.47 in year number one. So in our savings account, year number one, we have $2,799.27. Year number two, we pay another $2,551.80 to ourselves. Credit card, of course, is still at zero. Now we have accumulated $5,354.83. And on our savings account, we've earned $3.70 this year. Year number three is exactly the same. Except this year, we've earned $6.07. Inside of our savings account, we have $7,912.70. Year number four, we don't pay ourselves the entire year because we would have been done in 41 months. So we only pay ourselves 5 months in this case. Because we only paid ourselves 5 months, the growth this year in our savings account isn't as much. It's only $3.20. This does not include the fact that you pay yourself every single month, so there's additional funds in your savings account to use. We're only focusing on the $6,600. Here we have it. When we use our savings account, we started off with $6,600. We then withdrew $6,354 to pay off this credit card, and we paid ourselves $212.65 every single month for the next 41 months. And it allowed us to not only recapture the minimum payment, but that payment included principal and interest, which is why in our savings account at the end of the term is $8,979.15. In order for the policy to be beneficial, there has to be more money available in that policy than it is in the savings account.
Let's check out the scenario in which we use a policy to pay off the credit card. Now for this example, you have $6,600 of cash value, meaning liquid cash that you have available that you could use to pay off your credit card. There's some details that we need to cover, and this is where people get confused. So make sure that you pay close attention to this section. The $6,600 that I referred to, which is the cash value that you have available in your policy, you don't necessarily need the whole $6,600 because your credit card bill is $6,354. So essentially you only need $6,354 available. You don't have to access all of the money from your policy. And we're going to request a loan from the insurance company so that we can gain access to $6,354. But guess what? You are not going to use your money. No. You are not going to use the money directly out of your cash value. In this case, you are getting a loan. And what does a loan entail? A loan entails you using the power of leverage because you have $6,600 available in your life insurance policy. And all we're going to do is leverage your life insurance policy to gain access to OPM. OPM is other people's money. You don't want to use your money. In this case, we are going to use the insurance company's money. We are going to ask the insurance company for $6,354 because we have that money available inside our life insurance policy. Now, if you withdrew $6,354 out of your insurance policy, you would lose your ability to earn that 4% compounded interest rate because the money is no longer there. And if we are owning our own lifestyle, we want to put ourselves in a position where we can earn as much money as possible. So instead of getting a withdrawal, we are going to get a loan, meaning we are going to utilize the insurance company's money so that our $6,354 can continue earning that 4% compounded interest rate. So remember, with the power of leverage, we are leveraging our life insurance policy to call on the insurance company and say, hey, we have $6,354 available. Can we use yours instead? Because we want our money to continue to earn the 4% compounded interest rate. And the insurance company is totally fine with this transaction. And you want to know why? Is because they have collateral. Collateral meaning something pledged as a security for repayment of a loan to be forfeited in the event of a default. So if you don't pay the $6,354 back by the time you die, the insurance company is going to subtract that amount of money from your death benefit and pay the rest to your beneficiaries. Since the insurance company has their collateral, their security for loan repayment, they're going to write you a check for $6,354 that will then be deposited into your checking account so that you can now use this money to pay off your credit card. And what the transaction ends up looking like is this. You have $6,600 of cash value available in your policy, but remember that $6,354 is held for collateral, so you still have access to $246 inside your policy. Now, although your $6,354 is being held for collateral, this money is still earning that guaranteed 4% compounded interest rate.
So like Carmen said, after we borrowed $6,354 from the insurance company, we paid off our credit card. Our credit card balance is zero. For the next 41 months, we pay $212.65 back to the insurance company. From your income, just like you were paying the credit card, we're going to pay this to the insurance company. After 41 months, we have paid $8,718.65. This is the exact same amount we paid to our savings account when we withdrew the money. So far, nothing's changed. The only difference is instead of withdrawing the money from our whole life insurance policy, we instead used it as collateral and got a loan from the insurance company. Here's where we want to pay attention. After we've paid $6,354 back to the insurance company for borrowing the money, remember we borrowed $6,354, we return this payment back to them and we're left with $2,364.65. But remember, they charge us 5% simple interest when we use their funds. After 41 months, we've paid them $570.33 in interest. So if we add this to the $6,324, we've satisfied the insurance company by paying them $6,924.33. Now, what was going on inside of our insurance policy? Because we never touched it, we never disturbed the interest that we're earning. So we continue to earn 4% interest. And the reason why this is compounding is because we never moved the money. Our money inside of our insurance policy is earning interest on top of interest every single year. And not only have we been earning interest every single year, we've been earning interest on $6,600 because we never touched it. Inside of our policy, without us not having to do anything, we have $7,564.82. And the only thing we did is pay back a loan and pay back interest. Is this $1,794.32. Because remember, this is where we paid the insurance company their $570. So we're left with $1,794.32. That is additional interest that we add into our policy. So the cash available inside our policy now that's earning the 4% guaranteed is $9,113.14. So let me break this down for you. Here I have the column year 1, 2, 3, 4. This is the years it's going to take for us to pay off this credit card debt using our banking system. We have the cash available inside of our policy. This is the loan that we receive from the insurance company by using our policy as collateral. This column represents the credit card cost at 19.24%, followed by the amount of money that we're paying to the insurance company. Even though we're paying ourselves, we have to pay interest on the amount of money that we borrowed. So whatever's outstanding every single year, we pay 5% interest. Now, our policy itself is still going to be earning the 4% interest because we're never disturbing the interest inside of our personal policy. This death benefit doesn't mean anything in this example, but what I want you to remember is this is still life insurance. So this is an added benefit to having a life insurance policy. And this death benefit is going to be based on a handsome 33-year-old male who's going to remain nameless. So year number 1, we borrowed $6,354 from the insurance company, which leaves $246 available for us to borrow. This is the cash value that we have available to borrow. The credit card is paid off, but we continued to pay $212.65 faithfully every single month for an entire year, which came up to $2,551.80. Now, this is the amount that we paid in interest, $317.70. This is based on $6,354. So 5% of $6,354 is $317.70. Our policy in the meantime, earn $268.89 in interest, even though we've borrowed the money from the insurance company. The only cash we have available is $246, but we still earned in interest $268.89. And I know you're saying, like, Darius, you spent more in interest than you earned in your insurance policy. Yes, but bear with me. Let me get through it. Year number 2 is going to be exact same payments that we're making. Now we have accumulated $5,390.53. The loan that we have outstanding for the insurance company is $3,802.20, which means that the interest we pay is on a smaller balance. So we don't pay as much interest as we did the year before because we don't have as much money outstanding. So this year we pay $190.11. But take a look at this. The interest that we earned at 4% is $279.85 just for this year. We're getting better. It's a little more than what we paid to the insurance company. So in year number 2, we were able to pay a higher interest than what we're earning and still make a profit. Let's move on to year number 3. Year number 3, the cash available in our policy is $8,171.06. The loan that we have outstanding is $1,250.40. Of course, the credit card cost is $0 because we're making the payments not to the credit card company, but to the insurance company. So we've paid another $2,551.80. But the interest that we pay is only on $1,250. So the interest that we pay to the insurance company this year is $62.52. But the interest that we earned year number 3 is $291.25. Now, year number 4, we've paid back the loan, so we don't pay any interest, but we're still continuing to make the minimum payments until it's paid off. So we paid ourselves $1,063.25, and we've earned $124.83. So again, what I wanted to illustrate is isolating this loan of $6,600. So now what we have available in cash to borrow is $9,113.14.
Now let's compare these together, shall we? If you recall, the savings account is paying you 0.09% interest, and the insurance company is paying you a 4% interest rate. However, in order to get a loan from the insurance company, you are going to have to pay a 5% fee. And if we recap the balances on these accounts, the savings account had $8,979.15, and the life insurance company had $9,113.14. The savings account, you used cash to pay off the credit card. With the life insurance company, you leverage your life insurance policy to get a loan from the life insurance company so that you could use their money to pay off the credit card, and you paid the money back to them, but you were still able to pocket the additional interest that you paid to yourself. Now let me show you what it looks like when we put the graphs together. In year 1, if you just look at the cash availability, it looks as though the savings account has pulled ahead slightly because the savings account has $27.99.27 in it, and the life insurance policy has $27.48.99. Now with the life insurance policy, we did get a loan versus the savings account just withdrew the cash. In each scenario, we paid ourselves $212, which was the amount of money we would have been paying the credit card company anyway. Now, the only difference, remember, with the life insurance policy, there's a fee associated with this transaction because we use the life insurance company's money. So in the very first year, we paid $317.70, and in the savings account, we didn't pay any interest because we didn't get a loan from anyone. However, if we look at the interest rates, you'll notice the interest rate with the policy is $268.89 versus the savings account is $1.47. So if we just single out the interest, it's important for you to note the interest that is being paid on the $6,000 balance. And then if we bring the death benefit into focus, you are able to use your life insurance policy for banking functions, but don't forget that this still is life insurance. So if something were to happen to you, there is a death benefit that will be paid to your family in the event of your death. And of course, in the traditional savings account, they don't have any death benefit. Now I'm just going to go quickly through the second year since we've laid everything out. Now, one thing that you'll notice is that in the very first year, the savings account is ahead. However, the savings account will never be able to keep up with the policy moving forward. And we've only singled out 4 years. So in year 2, the policy pulls ahead slightly because the balance that's available for cash to use is $53.90 versus the money that's in the savings account, the availability is $53.54. And then so on and so forth. In year 3, we have $81.71 that's available, and then $79.12 that's available in the savings account. And then in the very last year, we end up with $9,113.14 versus $89.79.15. Now, the gap that we're talking about between these two, with just single out these first 4 years of paying out a credit card, isn't super significant. However, there's some things that we didn't take into consideration in this presentation. And the first thing being is the continuous payments into the policy and the savings account. As this individual continues to fund the policy or the savings account, those accounts are going to grow. And if you notice, we're only talking about 4 years and only $6,600 if you continue to fund the policy at a 4% compounded interest rate. There is no way the savings account would be able to keep up with a policy that's continuing to be funded at a 4% interest rate. The other thing that we didn't take into consideration is the non-guaranteed dividend payout that can happen within a policy. Each year on the anniversary, when the insurance company has paid all of their overhead, whatever money is left over is returned back to the policy owners in the form of a return of premium. And all of that money is put into your cash value, which can be $20 or it can be thousands of dollars, just depending on your premium payment and how old the policy is. So that's a bonus that we didn't take into consideration with the policy. And the other thing just being the death benefit, we didn't mention it much in this presentation, but that's definitely an added feature that we would consider when we're talking about creating your own banking system that has the perk of the death benefit.
Now that you understand the infinite banking concept, it's up to you to decide if this is something that you want for yourself and for your family. And remember, the information that we shared with you was just the concept as far as infinite banking is concerned. We're finding so many people just get caught in the policy mechanics and don't ever focus on what happens when they actually get a policy, which is the most important part. So we just want to make sure that at any given point throughout your journey, you're always focusing on how you are going to bring back all of the interest that you're paying to the banks, how you're recapturing that money so that you can reuse it over and over again to finance your lifestyle. Do not forget that infinite banking is what happens after you have a policy.
So just to piggyback a little bit on what Carmen said, do not get analysis paralysis on the policy itself. Infinite banking is about what you do with the policy once it's enforced. So with that said, if infinite banking is something that you are interested in and want to get started with, click the link below to become our client.
And if you want to join a community of like-minded high achievers just like yourself, join our Patreon community so we can teach you how to navigate this sometimes tricky space.
If you like this video, make sure you hit that like button and also leave us a comment as to how we can help you with your infinite banking journey. And also share this video with a friend.
And don't forget to own your own lifestyle.
Or someone else will.